going to take a look at what I call the only free lunch, and academics call the only free lunch in investing, which is we can get higher expected returns for given levels of risk when we put portfolios together in very specific ways. Now, the question is this: are fund companies actually doing this? I think you may be surprised. And are there risks that investors are taking right now that they're not even aware of? Stay tuned for that. Now, if we look at how we put portfolios together, we'll have different asset classes. You'll have large companies, small companies, value, growth, US, international, and so on and so forth. And what we know is that if we look at what's called a vortex, we can look at history of returns in an asset category. And what we notice is that our one-year returns of an asset class, there's a pretty wide dispersion throughout history. This is looking at the last 30 years. And what we notice is that you may have 1 year where you have a very high return for large US stocks, and you'll have another period in time where you may lose 30 to 40% of your money in 1 year. But what we notice is when you hang on to an investment and an asset class, that historically our 5-year returns are in a much narrower dispersion. They're it's squeezed as far as what the high returns are and the low returns are. If we hold it for 10 years, it's squeezed even more. And we go out to 15 years, squeezed even more. We go out to 30 years, and this, not just the last 30 years, which is what this is showing. We look at every 30-year period in history, we notice that large US stocks are within like 1% of a 10% return, even dating back to the Depression. So we look at that and go, well, that's a pretty big dispersion right there. That's a pretty wide range. I don't think I can take that much risk. And you may be right. That's not a good idea. Well, let's take a look at what happens with other asset categories. Do we see the same thing? And can we use this to help reduce the risk of an overall portfolio? With large value stocks, we see it's even a greater range because value companies are more risky companies. So we would expect a wider range. But we see the same thing happening over time. This is the vortex where we come in and we close in on the expected return over long periods of time. Now, if we look at small companies, again, we see the same thing. Isn't this interesting? This vortex concept holds with different areas of the market. Small value, same thing. Big dispersion of historical returns over 1 year periods over the last 30 years. But again, we close in on the long-term returns. And we can keep going. International companies, international large value, you see the same thing. International small companies, you see the same thing happening. International small value. We're going to come back to this asset category in just a second. Now, 1-month treasury bills or something like CDs, we would expect almost no variance in 1-year returns because they're no risk. We call it the risk-free rate. But then again, what do we also not get? We don't get return for this asset category, so we don't want to put all our money there. Matter of fact, going back to the 1920s, the return of treasury bills has been barely above zero above inflation, almost no return above inflation. Now, this is, I call it a spaghetti chart because you see all the asset categories since the time I opened Paul Winkler Inc. These are all these asset categories and what they've done. You see that they're all over the place. You see treasury bills right here, basically straight, no variance in returns, but you see the ups and downs in the market. Now, if you're taking an income, we want to make sure we have something like fixed income investments that hold value when stocks go down, because they can go down together is what we see right there. More about that in a second. So the goal of diversification is this: putting things together that historically do not move with each other, dissimilar price movement. Now, when Markowitz taught this, the guy that won the Nobel Prize for this concept, he said, hey, you can take this asset category and combine it with this asset category. And in an academic's dream world, you have a portfolio with less volatility than the parts is the idea here. That's a dream world where everything can go straight up. But I want you to get the idea, dissimilar price movement. Bathing suit sales versus winter coat sales is often how I explain this. Now, let's look back at the last, since I opened this company in the year 2000, I'm just going to take this to make it a little easier to see. We're going to look at 2 asset categories. We're going to look at small international value companies, which most people don't even have in their portfolios. But I want you to see the first 12-year period followed by the next 11-year period since we've been around, what happened over that period of time. What you'll notice here is this is large US stocks. This is what most American investors have most of their money in. And you see over that first 12-year period, literally treasury bills had a higher return over that period of time. Over that same period, international small value, it like quadrupled over that period in time. So you see that they had very, very different outcomes over the first 12-year period. Now, the next 11-year period that followed, it was the other way around. US stocks did better than small international. So it wasn't terrible, but the reality of it was this area did better. And a lot of people right now, because they're so familiar with these big US companies, are getting overly excited, I think, and putting too much money in that area of the market because of this recent past performance. It's a mistake that investors make all the time. They look for something that's done well in the recent past history, and they just complete the pattern in their mind that this is going to continue to go up and this is going to continue to meander. And nothing could be further from the truth if we look at history. Now, what you're noticing right here is a portfolio of 60% stocks, 40% fixed income. After all expenses, it's a GIPS audited portfolio. And what you notice is this, the dispersion is a lot tighter right here. So somebody that's in retirement, it makes more sense to diversify because when you diversify, you can squeeze that dispersion over short periods in time and then close in on the return in the long run. So that's the reason that we put things together. Now, this is a very conservative portfolio, but I just wanted you to see how this works. And we look here, we can see we do the same thing. And this is something we teach in our first workshop where you combine international stocks, which is the blue, and US stocks in the orange or yellow right here. And what you notice is that in the 70s, international stocks outperformed US. And then in the early 80s, US outperformed international. In the late 80s, international again outperformed US. And in the 90s, of course, we had US outperforming international, and then in the 2000s, international outperformed US. So basically they outperformed and what happened each other in different periods in time. And what happens when I own them both, that's the red line. And you can visibly see how the red line is less volatile than the parts. The idea behind diversification. Now, if we look at this, we can get granular and look at 1-year periods. So let's say if you were taking an income or as an investor, you're going, hey, I need to take income from my investments. That's what I put them there for. You'll notice that in a year like 2000, where, value stocks did fine, where large growth companies and small companies and microcap companies and, some international asset classes just didn't do that well. Well, I would be really glad that I owned something that did well that particular year. And then, let me keep going just for a second so you can kind of see what's going on here. But you notice how the asset category that has the top return changes year after year back through the year 2000 until now. And it's random. Well, that's the idea when I'm taking income. I always want to have something in my portfolio that's doing okay that I can take income from. And that's another reason we diversify, not just for short-term volatility, but for taking income as well. Now, what do fund companies typically do? Do they do that? And you're going to notice right here, not necessarily. This John Hancock fund, if you look at how much they have in small companies, it's 0.75% of the portfolio. 0.75 is in small stocks, and microcap stocks, 0% of the portfolio. Not really well diversified. How about the Fidelity Fund? This is a 60-40, approximately 60-40 portfolio. And you notice right here is almost nothing in small companies. Again, not diversified. Vanguard, Life Strategy, moderate portfolio, another portfolio that is supposed to be diversified. And again, 3% in small, 0.89 in microcap or small companies, very small companies. So again, not diverse. And you can see that right here too. If you look at the style box, what that's showing you is predominantly most of the money is in large companies. So it's not that well diversified. How about, and we don't have a dog in the fight. I mean, we don't sell mutual funds or get paid by mutual fund companies. So I'm picking on these companies just because they're well known. Voya may have cute squirrels and everything, but they're not well diversified. The squirrels in the commercial. But you notice they're not really well diversified right there. 1% in small and 0.02 in microcap. So here's the problem. You notice that most of the money is in very, very big companies. And there's a concept in investing. We look at what price stocks are selling for compared to the assets of the company. Companies typically sell for a multiple of their assets. The lower the price, the more potential we can have for growth because there's more room for the company's stock price to grow. Notice something on this chart. What asset category is way overweighted compared to the rest of the asset categories? That would be large US stocks. You see them selling for a very, very high price. Not saying that they're overvalued. We can't know that in advance. We only know it in hindsight. But I just want you to see that most American investors have most of their money here, and it is a very, very high price asset category compared to small and microcap and value and international small. And you notice that those funds did not have good exposure to those asset categories. So a lot of people may be in for more risk than they really think. What happens so often is fund companies will advertise this stuff and say, hey, look, we're a one-stop shop for all US stocks, this Vanguard Total Stock Market Fund. That's what it says here in this Morningstar report. Well, if you look at this report right here, and I'm coming to the conclusion on this so you see what's going on, you notice that there are 10 holdings that are the top holdings in this mutual fund. And what I want you to notice is that this fund has 3,653 stocks in it. Okay? Now, the top 10 holdings are Apple, Microsoft, Nvidia, Amazon, Meta, so they have this list right here. Notice something, if you add up the percentage of the money that's in these stocks, almost 30% of money invested in this fund are in just 10 stocks. That means that 10 out of 3,653 companies, or 0.02% of the holdings of this fund, hold 30% of the money. That is a huge problem, or could potentially be a huge problem, because these companies are making up so much of it. Now, anybody remember the tech bubble, technology companies in early 2000 through 2002, where technology stocks dropped, like 80%? Well, if you look at the top 10 holdings of this fund, I'm not saying that's going to happen again, or I know that's going to happen again, or anything like that. But I just want you to beware that if you look at the top 10 holdings of this fund, this stock is a tech company. That tech company, Microsoft, Nvidia, Amazon, Meta, Alphabet, Broadcom, 8 out of 10 of these holdings in this portfolio of the top holdings are technology companies. Think that can't happen again? You may want to think twice. It certainly can. And you notice again with this fund that most of the money is where? Most of it's in large companies, very little in small companies. Recognize that most American investors aren't well diversified, and friends don't let friends invest in this manner. Make sure you send this video to some of your friends, because chances are really good they're invested this way.